Welcome to this event today, hosted by the Poverty Action Lab at MIT on mobile money impacts, challenges, and open questions, running for the next about 90 minutes. Let me quickly outline the agenda for today. I'll give a few opening remarks, and then Seth Gars from the Gates Foundation will sort of talk a bit about the evidence. Leora Clapper from the World Bank will talk about open research questions. And then Dr. Batangi Demo will talk about regulation and challenges of regulation. And then we'll have plenty of time for Q&A before Jenny Aker closes. So welcome everybody. It's really a pleasure to have you all here this morning. It should be a great, fun panel. So I'm hoping you guys will engage and have lots of questions for the panel. I want to thank the JPAL team for organizing this event. And I just want to spend a couple of minutes talking about an initiative at JPAL that we've had for the last couple of years called the Digital Identification and Finance Initiative. The initiative tries to study questions around digital identification systems that are now being rolled out across several countries in Africa. And tries to understand the impacts of these, as well as the impacts of digital finance on standards of living and poverty and other sort of measures of well-being in sub-Saharan Africa. You know, at JPAL, as probably most of you know, we use randomized controlled trials to understand the impacts of things. And so we fund a bunch of randomized controlled trials under this umbrella agenda of Digify. In addition to that, we actually have an African Scholars Program as part of Digify. There's a bunch of information on our website. Please look it up. If you have any questions, please reach out. With that, I want to hand over to the panel because we have an awesome panel for you today, and I'd like to get them started and off to the races. So first up today to talk about the impacts of mobile money in general is Seth Gars. Seth is a senior program officer for research in the financial services for the poor division at the Bill and Melinda Gates Foundation. He's been there for about 3 years. Before that, he was a postdoc at Berkeley and got his PhD at Berkeley. Seth, welcome. The floor is now yours.
Thanks a lot, Professor Suri. It's a real pleasure to be here, and thanks to JPAL for hosting. It's humbling to be sharing the screen with so many research all-stars. Just to dive in, I am going to spend my time focusing on the interpretation of evidence on the impacts of digital finance. I'm going to try and do that in about 14 minutes now. As Professor Suri mentioned, I manage the research portfolio at the Gates Foundation's Financial Services for the Poor strategy. And so in interpreting the evidence, I'm going to kind of lead with the conclusion here, which is my key takeaways, which is that there's robust evidence that suggests there are large and consistent impacts of mobile-based digital payment services, specifically mobile money, on behavior that is consistent with key pathways out of poverty. DFS enables more efficient inter-household transfers, so between households, and intra-household domestic remittances, so within household remittances. It enables better consumption smoothing in emergencies, and shifts poor households towards higher productivity occupations and migration away from low productivity regions, low productivity subsistence agriculture. Now, those words were chosen very intentionally, so let's unpack them, okay? So first of all, when I say robust, you know, I think it's really impressive. We're going to see at least 9 studies in particular on payments, on digital payments. And that, when you compare it to the literature, the emerging literature on digital credit or insurance, is really a lot of papers. Now, what's interesting about those papers is that they all suggest really large impacts, particularly compared to other literature for financial inclusion on savings, for example. And remarkably, they're incredibly consistent across studies, kind of unbelievably so in many respects. And we'll talk about that. And, you know, in comparison, when we look to other literatures like the literature on microfinance, you see much more varied impacts that are more difficult to interpret, okay? Now, here I said mobile-based digital payment services. For those who are really familiar with mobile money, you'll recognize that Mobile money, it means different things to different people. It's governed in different jurisdictions differently by different regulations. But by and large, I'm talking about mobile money. Okay. Now, just to give you a sense of how large some of these impacts are really quickly, we just a bit of a preview. 25% reduction of food insecurity in Uganda, right? So in Mozambique, folks that were facing household shocks were able to maintain consumption 20 to 44% higher than those that didn't have access to mobile money. Just quickly skipping to the Bangladesh on the far right, we see, by encouraging folks to adopt mobile money, increase in remittances of 26%, which translates into increased consumption back home of over almost 8%, okay? So very, very large impacts, which are very exciting. Now, for the rest of the presentation, I'm really going to focus on starting by unpacking the cause and effect of the kind of the narrative of how this works. And then we're going to really interpret some of the academic literature in particular. And I emphasize interpretation because it's never straightforward to put together a collection of papers. So instead of just merely translating, this really is a bit of an interpretation. And then we're going to dive into some specific evidence, hopefully if time allows, on consumption smoothing and migration to higher productivity. Okay. So a quick plug here just for a couple of resources. This presentation largely reflects a recent op-ed that I published at the World Bank, and there are resources available here on the right at the Gates website for those who are interested in just foreshadowing, teasing that we have a presentation kind of in the pipeline focused on DFS, digital financial services impact on women's economic empowerment. And I'll try and drop links in the chat for everyone. So let's start here with kind of like a framework for unpacking cause and effect, okay? So if you start on the left-hand side here with digital financial services, we have, the first impact is kind of transaction efficiencies, right? So you have cost savings, you have faster transactions, and you have time savings as a result of digital financial services. Those are just basic aspects of the technology. If you didn't have that, there would be nothing to get excited about. It's really an artifact of the technology. It's fascinating, it's essential. The really interesting stuff starts to happen with these first order behavioral impacts. So as a result of these transaction efficiencies, you get the larger magnitude of transfers between households, and within households, you get increased likelihood of transfers. And then importantly, poor households facing shocks are able to draw on a wider network of senders for support. Okay, so in times of crisis, people can ask and request money from friends from further away, for example. That leads to the really interesting stuff, which are the second and third order behavioral impacts. In particular, we see that, again, in these times of emergency, people are able to smooth consumption, okay? In other words, compared to folks that don't have access to mobile money, people that do are able to avoid reducing their consumption. They have higher levels of consumption, and therefore able to kind of sustain themselves across natural disasters or health shocks, things of that sort. We also see that they increase their labor productivity in the context of mobile money. So folks that, for example, will travel to a city to work, when they have mobile money, they actually work more and make more money to send home. And then finally, these third order behavioral impacts, we see people shifting toward more productive occupation, so towards self-employment in many cases, in most cases. And in fact, often this will facilitate their migration to more productive regions. So out of subsistence agriculture towards cities, which is consistent with what I'll call pathways out of poverty, okay? So in particular, only in a handful of studies will we actually observe impacts on poverty. But these are behaviors that we'll see in many of the studies that are consistent with poverty impacts, which ultimately is really what we're interested in, okay? Now, I will say that there's a lot of dynamic effects here, right? So the world is complicated. So in some cases, when you increase your labor productivity, that's going to increase the amount that you use digital financial services. So you have this kind of feedback loop. The brilliance of the researchers, some of whom are on the call today, in how they've created this evidence is they're going to be able to shut down these kind of reverse arrows here, this reverse impacts through various methods, statistical methods, randomized control trial methods, to give us confidence that the impacts we see are clean impacts. They're causal impacts, start with digital financial services and lead to these kind of first, second, and third order behavior impacts, okay? Now, they're going to do so by taking advantage of some of the catalysts of DFS adoption, digital financial service adoption. So on one hand, there are going to be various encouragements to adopt digital financial services through training or free phones. Alternatively, they'll take advantage of kind of the rollout of the expansion of agent banking networks, right? So over time, as the banking networks expand across the country, researchers can take advantage of that to compare folks that do and don't have access to agents in the early stages of the rollout, okay? So this is what I'll call like the causal framework. For those that prefer looking at outcomes as opposed to kind of arrows, you can think of some of the findings organized in these buckets. And these are kind of some of the key findings. We're going to see key findings that mobile money in particular encourages and enables more consumption, in particular smoothing consumption across moments where poor households face emergencies. And are better able, and that's going to be because they're better able to share their risk with people in their social networks. Okay, and ultimately we're going to see that this has impacts on poverty, which is very promising. And there's some specific statistics and citations here. On the right-hand side, we're also going to see labor market outcomes and impacts, which are very exciting in terms of enabling workers to shift to more productive occupations, largely self-employment in particular. And what's particularly exciting here is that there are often impacts specific to women. In particular, in Kenya, we're going to see a shift to self-employment among women, which is very exciting from women's economic empowerment perspective. We're also going to see increases in remittances, increases in migration. One thing to highlight, and this might be counterintuitive to some who, for example, may have spent a lot of time thinking about savings, is that the impacts of mobile money and savings is not always consistent across these studies. And that might not sound exciting, but in some sense, we might not expect that there would be impacts on savings. So for example, if you're a household facing a health shock and you request money from a distant relative, you're immediately going to spend that money, right? You're not going to save that money. And so it's not necessarily disheartening to see that savings is not consistent across studies. I'm not going to talk much about savings. There are a number of studies on it. But wanted to emphasize that here is kind of a counterfactual to what we don't see, right? And so it's really important to understand this causal framework and not just anchor ourselves on some of the outcomes that we're accustomed to, okay? So with that said, I just want to show you, and there are a number of studies I have about, I think 16 here. I think the first 9 or so are really strongly focused on payments and the impacts of payments that emphasize smoothing of consumption across shocks. And what you'll notice in the methods category is that many of them take advantage of natural experiments, rigorously showing that using applied kind of statistical methods and research design, that the impacts we see are a result of digital financial services. Okay. There are also a number that take advantage of randomized controlled trials, which obviously JPAL has championed throughout the community. And still others use some other methods. In some cases, they're just descriptive. And you'll see the outcomes organized here, very consistent impacts on consumption. A lot of these have to do with labor outcomes as well. All of them basically focus on key kind of channels of impact through transfers and remittances. Some with migration, and a couple of the studies focus on savings, okay? But let me dive into, before I dive into specific studies, let me also emphasize that I'm motivated that earlier, a lot of the researchers are going to take advantage of encouragements to adopt digital financial services. And we see in selection A here on the top red box, that an example of that is that participants will be given, in this case, the 30 to 45 minute training session, very light, low cost training session, and kind of practice with transactions. That would be an encouragement, right? In selection B here, we see that participants actually receive a mobile phone and training on how to use a mobile phone, a mobile money account. That's another example of an encouragement. And then finally, an alternative approach is researchers will actually recruit mobile money agents in places that otherwise don't have mobile money agents, right? So the intervention is on the level of the agent, not necessarily on the level of the household. And you can think of a variety of these interventions as available to kind of development actors. Some of them are very naturally kind of facilitated by commercial players, folks that are rolling out agent networks. So the big network operators, the big telecoms, things of that sort. Others are more relevant for kind of NGOs and development actors in particular. Okay. So with that said, let's quickly look at transaction efficiency. Across a lot of studies, this is from Bangladesh in particular, we're just going to see that mobile money is vastly cheaper. So in this case, for, I think it was the transfer of 4,000 taka in Bangladesh from the capital to rural Bangladesh. It cost about $1. Compared to, if you were to travel yourself or give money to family members to pass the money along, which cost about 10 times that on the top here, right? Of course, the time is instant if you send mobile money, more or less, versus days of time to transfer money through analog means, right? So this is unambiguous. This is only a feature of the technology. In terms of time saved, on the left-hand side here is the study from Niger. You see upwards of between time saved in travel and time saved waiting. You can see 4 to 5 hours of time saved, right? In maybe a more general example in a microfinance group on the right-hand side here, you see about 30% decrease in time spent for deposits and about 70% decrease in time spent for withdrawals. So still substantial time impacts. And for women in particular who have all kinds of responsibilities that are otherwise not necessarily observed, all kinds of time costs, you can think of these as major impacts in particular. So very promising for women as in particular, but everybody more generally. Okay, so now getting to the exciting stuff with the remainder of our time, we're going to try and dive down into a couple studies. So we'll start with this, kind of first, second, third order behavioral impacts on consumption and occupational shifts. Okay. So Professor Suri and co-authors have a series of papers that were really foundational to this literature. And I first want to emphasize that we see in one of the early papers here from 2013 that M-Pesa, so the mobile money system in Kenya, really facilitates what we think of as more reciprocal transfers. So I highlighted them in green here. Green is kind of our first order impacts. And the types of transactions, these are executed over longer distances. So about 100 kilometers greater distance for those that had access to mobile money. And Professor Suri can correct us on the details if any of this is inaccurate. And that, in fact, people with access to M-Pesa were more likely to have new friends, so additional people that were sending, more people that were sending them transfers in these transactions. Now, of course, so it's not just that there were kind of able to transact further distances, but the implication of that, and this is kind of documented rigorously, is that there are more people, so an expanded share of one's social network is contributing in times of emergency, okay? So in fact, 22% increase in the fraction of people sending money to households facing health shocks and things of that sort. That increases the amount of remittances received. And of course, in this moment in time, and you'll see this in the blue box in the middle from this second study from 2014, whereas households that didn't have access to mobile money reduced consumption by 7%, those that had access to mobile money actually were unaffected. They were able to smooth across these shocks that they faced, okay? And this is specific now to folks that are experiencing household shocks. It's not a general phenomenon, but these are impacts that are very specific to households that are facing shocks. I will say that that is very common for households in poor communities to be facing shocks. So this is still a very large impact. And ultimately in this third study, we see over the long term that in particular, women are able to shift occupations towards business and sales and away from farming in this purple box here. And ultimately, this really leads to a long-term reduction in extreme poverty. Okay, so a 21% decrease in extreme poverty, which is of course the holy grail. And this is one of the studies where we're directly going to observe impacts on poverty. So I think I have maybe a minute left, 2 minutes. I'm going to zoom to a couple others. So there are a number of studies that really kind of extended and in many sense replicated these initial series of studies by Professor Suri and co-authors. So we have a study here from Uganda where we see impacts on remittances that leads to impacts on consumption. Okay, we see a study from Tanzania, which again replicates very similar impacts, particular impacts on folks that are experiencing household shocks. And when I said consistent large impacts at the beginning, when I was motivating our key takeaway, it's remarkable. The impact here on consumption is almost exactly the same as what Professor Suri and others saw in Kenya. This is Professor Riley's paper from 2018. So a 7% difference in folks that have mobile money versus those that did not. Okay. This is actually a randomized controlled trial that randomized introducing agents. These are colleagues of Professor Clapper's, I believe, at the World Bank. And again, we see a shift in, if you look at the purple box, a shift towards self-employment in areas that had access to agents that otherwise did not have access to agents. Shifting towards non-farm self-employment increased, almost doubled in these areas, which is really remarkable that the presence of mobile money agents is going to be changing people's occupation towards more productive occupations. Okay. So really quickly, I just want to feature two more studies and then I'll be done. There's one study here from Mozambique, which again shows these very strong impacts in the context here of a natural disaster, a major flood. 44% increase in consumption compared to those that did not have mobile money. This is an RCT in rural Mozambique in a migration corridor. And lo and behold, we're actually going to see households with access to mobile money, so where there were agents randomly introduced in the early years of the mobile money rollout, we're going to see impacts on reduced agricultural activity, in people migrating from the rural countryside to urban centers. Okay, two major impacts. And then finally, and this will be the last slide that I mentioned, is a very recent, actually, I think it's just now published in a major journal, from rural Bangladesh, where a very poor region of the country, rural households, very vulnerable households, were encouraged to adopt mobile money. In Bangladesh, it's bKash. This translated into, when migrants go to the city, some were now using, randomly selected group were encouraged to use mobile money, and it encouraged them to use mobile money. They not only worked more and earned more money, that translated into about a 26% increase, you can see in this blue box, of the remittances sent back home to the countryside, which ultimately translated into about an 8% increase in daily per capita expenditure, which resulted in the red box here of a 42% decline in extreme poverty. So just absolutely really large impacts, consistent across studies, robust across a number of studies here. I regret that I don't have time to go through all of them. They're very exciting, very innovative research designs. I'm going to stop here and pass it over, but thanks for the opportunity to present, and I look forward to the conversation. Over.
Thanks so much, Seth, for that introduction to evidence. I'm going to now ask Leora to talk a little bit about the open research questions in this area on digital finance. Let me just introduce Leora. Leora is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. A bit of a mouthful, Leora. Her work focuses on innovations in digital finance, including corporate and household finance, banking, entrepreneurship, and risk management. She's a founder of the Global Findex database, if people have seen that, which measures how adults around almost the entire world save, borrow, make payments, and manage risk. She previously worked at the Board of Governors of the Federal Reserve and at Salomon Smith Barney, and she has a PhD in financial economics from NYU Stern. Leora, we're really pleased to have you here. Leora's been working on mobile money research for a while and is going to talk about what are the open questions. So thanks for being with us, Leora.
Thank you, Shannon.
Oh, sorry, one other thing. Can I just say, if folks have questions, please put them in the Q&A. I'm going to take them all at the end. You can direct them to a person or the panel in general, but just type them in the Q&A and there'll be a full Q&A session at the end, just as a quick reminder. Thanks. Sorry about that, Leora.
Thanks. And thank you for the invitation to join you today. Do you see my slides? Okay.
Yes, we do.
Wonderful. So I work at the intersection of research, data, and policy. And most of my ongoing academic research relates to this impact of mobile money products, especially for women. So Seth's excellent presentation discussed what I'd almost think of as the first generation of research, the important impact of mobile money on household welfare, including consumption, jobs, remittances, and savings, which has been incredibly important in driving evidence-based policies to expand access to mobile money products and encourage digital payments of government transfers, wages, and remittances. And so these rigorous research papers have very effectively motivated policymakers around the world to embrace the importance of formal accounts at banks, fintechs, and mobile money service providers, and the necessity to measure and promote account ownership at the individual level, meaning that it's not enough for the male household head to have an account, but the importance for younger adults, women, and other people within the household to also have their own accounts. So according to the GSM Association, about 300 million mobile money accounts are being actively used globally every month, an increase of over 100 million accounts from September 2018. And the steadily growing number of monthly active accounts suggests that more marginal customers, including poor and rural adults and women, are joining. But most of this activity is simply P2P payments between family and friends. I'm going to focus on what might be thought of as the next generation of research, studying how to leverage the use of mobile money accounts to receive payments and to provide additional financial services to mobile money, which may improve the welfare, especially of poor adults and their families. It's necessary to consider this discussion in the context of COVID-19, which has accelerated the use of digital payments as physical distancing became necessary, cash became unsanitary, and traveling to make and receive payments became a health risk. Governments use digital payment platforms to disperse stimulus funds, like Togo's Nabisi cash transfer program, and some providers decreased fee for payment services, like Paga in Nigeria, who allowed merchants to accept payments with no additional cost to customers. There's also a large surge in Asia in digital salary disbursements. For example, according to the Bank of Bangladesh, salary disbursements as a share of total mobile money increased from 3.7% in April 2020 to 7.3% in July 2020. And so a first order research question is understanding the impact of millions of adults receiving merchant payments, government transfers, wages, and remittance payments into an account for the very first time, and how to encourage these account holders to keep their money electronic and use their accounts for additional transactions. And so I'm going to focus on some specific use cases most salient in sub-Saharan Africa. These are just illustrative examples of opportunities to extend mobile money usage beyond payments. So first, payments to farmers selling in agricultural value chains. According to the World Bank Global Index data, if we find that in Kenya, Uganda, and Tanzania, about 10% of all adults are farmers receiving payments for the sale of agricultural products directly into a mobile money account. Excuse me. Increasingly, farmers are selling to agribusiness chains. Excuse me. For instance, we've been talking to tea growers who sell to Twinings in Sri Lanka, barley growers who sell to Heineken in Ethiopia, and these large buyers are interested to pay farmers directly into accounts, mainly because it's easier, cheaper, and more transparent. And it'd be interesting to rigorously measure the benefits to these large buyers from the lower cost of payments and the real-time visibility of procurement. Digital payments also supports farmers. This is important because farmers have huge needs for financial services. They often get paid once or twice a year, need to stretch that money to pay for daily food, monthly school fees, seeds and fertilizer for the next harvest. Digitizing their payments could be their first entry into the formal financial system and access to additional appropriate financial products, such as seed financing and index-based weather insurance. For instance, randomized controlled trial studies in Ethiopia find that increasing uptake of insurance against weather shocks can be an important component of strategies to improve yields and lift farmers out of poverty. But a randomized controlled trial in Malawi is just one of many studies on the challenges of encouraging take-up of these insurance products, even when bundled with credit. But perhaps mobile payments from buyers can be designed with auto-pay deposit payments to encourage greater savings and access to appropriate credit and insurance products. In addition, new digital products are tracking both the quantity and quality of agricultural sales. A challenge in these sectors is what we call traceability. For example, if all tea is dumped together, no one farmer has the incentive to invest in higher quality organic fair trade seeds. Traceability allows farmers to receive a higher price for higher quality, potentially secure advanced financing. A randomized controlled trial in Burkina Faso is studying the impact of digitization of payments and traceability in the shea butter sector, which is mostly grown by women farmers, to study the impact on both the digital payment and the traceability on these women's control over their resources. Real-time sales information can also be leveraged by new fintech applications, which have typically targeted underbanked workers and independent contractors who, like farmers, have lumpy income. Financial products can help smooth the income over time and avoid expensive moneylenders. For example, farmers can receive immediate access to earned sales instead of waiting until after the next auction, which might help these farmers better manage expenses and handle emergencies. Let's next look at domestic remittances. In 2017, Findex data found that almost a quarter of all adults in sub-Saharan Africa sent or received a domestic remittance payment directly using a mobile money account. But how can these adults be encouraged or incentivized to use their accounts? The benefits of financial inclusion are muffled if recipients of digital payments immediately cash out and store their money under their mattress. What are account use cases for recipients of digital remittance payments, wage payments, etc. Let's start with auto deposit savings accounts. We're conducting a randomized control trial with a bank in Ghana to develop an app that cautiously sweeps money from a mobile money account into an interest-bearing bank account, which has the added benefit of establishing a relationship and savings history with a bank that could potentially also extend credit in the future. Adults can sign up for the frequency and amount of savings into their account. So it's a soft commitment, meaning that there isn't money in the mobile account, money can't be moved into savings. But if coordinated with regular received payments, this can be very effective in helping people save for goals, even monthly goals such as school fees and utility bills. And the next case, if you use cases, clearly apply to all mobile money users. I mention them here as a way to highlight that without use cases, recipients of mobile money payments will simply cash out and transact in cash. So for instance, companies are also introducing mobile payments to promote access to solar energy and clean drinking water. For example, loan payments for water connections, storage tanks, and filtration can be combined with digital bill payments. In Kenya, Citizen Bank extended connection loans bundled with water bills and repaid using mobile money. Business models are also offering sub-Saharan Africans microloans to purchase solar panels and systems and repay using their mobile money accounts. The customers are becoming entrepreneurs by charging their neighbors to charge their mobile phones or use space in the refrigerator. But a survey in sub-Saharan Africa by my colleagues in CGAP find that pay-to-go payments are often paid by reducing women's household budgets. A rigorous evaluation could unpack some of these questions and identify some of these unintended consequences. Next, I mentioned transportation. In Kenya, matatu buses are used by about 70% of the population and are a dominant transport mode across the country. And passengers traditionally paid in cash. But when the COVID-19 pandemic hit, cash became unsanitary and the country wanted to limit the amount of time people stood in line. And so last fall, an automated fare collection platform was rolled out that leverages the M-Pesa mobile wallet, which is used by over 90% of the population. But it doesn't matter if riders pay by cash or using a card on their phone. Beyond the COVID-19 benefits of contactless payments, digital payments save time, which can increase rideshare revenue or help mass transit on-time performance. It's safer for both drivers and passengers to not carry cash. And there's evidence, including a randomized control trial in Niger of government transfer payments by Jenny Acker, who'll be speaking later, that greater transparency of digital payments can reduce opportunities for fraud. And digital transportation payments could also potentially help government collect taxes from transport proceeds. These are all interesting research questions. Finally, I'm quite interested in the benefits of digitizing tuition payments to be paid directly from mobile money accounts. A large project in Uganda reported anecdotal findings that digital tuition payments led to more students staying in school, especially girls. This is an intriguing result, especially when paired with the reported statistic that more than 3 times as many people make payments as there are students. Could it be like Tabnet's finds in a natural experiment in Kenya that owning a mobile phone gives you greater access to a wider geographic and social network of friends to call on when you need help paying your child's tuition? Is a worker in the city more comfortable sending money directly to the school on a regular basis rather than to his brother who could divert the tuition money? We'd like to investigate the administrative data to understand if some students receive money from more than one mobile money account every month, or if typically one account makes the payments, but there are some months when many people contribute small amounts. A randomized control trial can help us understand these channels, with the end goal of a mobile money account expanding educational opportunities. The last use case I'll discuss is merchant payments. If small merchants pay digitally for their inventory, this payment history could be used to extend working capital financing. Similarly, digital payments from customers could collateralize loans. In some cases, lenders are paid directly from the payment providers. If paired with an item scanner, firms can receive reports on sales trends by day and hour, which can lead to more efficient inventory management. Owners could also have auto deposit savings, which can help them save, for example, for the cash collateral they need to buy a new refrigerator or generator. During COVID-19, there's been a surge in digital in-store payments. Yet in new data that I collected this year, about half of all adults who reported making a digital in-store payment for the first time during COVID said that they wanted to go back to using cash. An additional challenge and research question is how to keep customers gained during the pandemic. This is hard. It requires merchants who are willing to make their sales more transparent and pay their transaction costs to keep accepting digital payments, and for customers to be comfortable using the technology and the mental accounting. For example, a natural experiment in India studied the 2016 demonetization, and the customers that shop online and pay digitally as compared to cash on delivery spend more and less likely return their purchases. In a 2000 study, with the caveat this was a lab experiment of first-year MBA students at MIT, researchers found that customers are willing to pay up to double when they pay digitally using a credit card instead of cash. Intriguingly, 20 years later, in 2020, the authors did a follow-up study to understand the why and used MRIs and brain scans to show that digital payments increase the pleasure of purchasing, which raises lots of interesting questions: how mobile money payments can influence consumers' habits and make them happier. Of course, it's not as easy as offering well-designed financial, it's not as easy as just offering well-designed financial products. People have to be willing and able to use the products, but there's reason to be optimistic. In a randomized control trial in Bangladesh that Seth mentioned, my co-authors and I provided some low-income garment factory workers mobile money accounts, while other workers received mobile money accounts plus electronic wage payments paid directly into their mobile money account. We found that over an 18-month period, garment workers paid directly into a mobile money account, payroll account. They learned to use their accounts and to send domestic remittances payments themselves without the help of an agent. Furthermore, we conducted what we called a mystery shopper exercise, where actors posing as garment workers performed mobile money transactions around the city. And we found that agents near factories that paid electronic wages were less likely to add on additional fees. In other words, workers who were receiving regular electronic wage payments became savvier financial customers. I'd like to end on the critical question of trust, which is key to the success of any mobile money product. Trust in telecom to keep your savings safe, trust that your employer can take away money from your payroll account if you leave your job, trust that connectivity problems won't interrupt a customer's payment and prevent you from getting paid, and trust that you're being offered fair credit terms. Ultimately, understanding how governments, banks, and telecoms can build trust with mobile money account holders is a fundamental research question we need to answer to encourage greater usage of mobile money accounts. So thank you.
Thanks for that, Lyra. I really appreciate it. As I mentioned again, Q&A, please feel free to populate the Q&A. We'll take Q&A at the end. I'm going to introduce our next speaker, Dr. Bidange Demo, who's going to talk about regulation and implementation challenges and achievements. Just to give a quick introduction, Professor Bidange Demo is the professor of entrepreneurship at the University of Nairobi's Business School. He is the immediate former permanent secretary in the Ministry of Information and Communications in Kenya, where he served from 2005 to 2013. He's an ICT champion and regarded as one of the key people who kind of oversaw a massive transformation in the Kenyan ICT sector. And he was instrumental in setting up M-Pesa. Dr. Demo, welcome. The floor is yours.
Thank you, Professor, for the introduction. My name, as Professor said, is Bidange Demo, and I've been working in this sector, the ICT sector, for some time. I was there when we worked on M-Pesa, so I'm going to tell you a story about it and about the regulation and the challenges that we've had. I moved from the government offices. I joined the board of Safaricom, which is the company that owns M-Pesa in Kenya. So first I would start when we started in 2007. We didn't even have an idea what the solution that had been created will do. We were simply responding to an idea where we wanted to send credit, where people buy credit for others and put and top up on their prepaid phones. But then it occurred that it could actually transfer some money. And the CEO then came to my office and said, can we find out what central bank would do? Because we were under the regulations of the Communications Authority. And the fear was if we touched money, the central bank would come into play. And so I approached the governor of central bank at the time she told me it is not possible because this is nobody else has done it, because there was nowhere in the world where mobile money or anything like that had been regulated. But then I was determined. I decided to get the Ministry of Finance, which is responsible also for central bank. I pushed it there. We had a wonderful president at the time. Because of disagreements, other people were saying there is no proper regulatory mechanism, there is no point of reference. But we were determined to take the risk. And the president was asking, what would this innovation do? And we gave a very simple answer that it's going to remove money from the mattresses and take it to the banks because people will need it on their mobile to send. Then he said, there's no problem with that. And so we went back to central bank. By then they had, we had covered from the seniors and it was allowed. But they were hesitant to give it an open book. So they kept on controlling how much money can be sent from person to person, where it started from. Then it started moving from person to business, and later to business to business. At every stage, central bank was a bit nervous that we don't know whether this would fall within anti-money laundering. If there was money laundering, how can we understand this? And so they kept bringing problems at every step. Even today, as we bring new products, the central bank is still not 100% like supportive. They need to go through several iterations. From the Ministry of Communication, what we were thinking is that if we begin to create regulatory environment before the product is out there, and we don't know how it's going to function, then we are inhibiting innovation. So we were much more fewer. We have, from the communication side, central bank very cautious. And I remember once when we had a new product, the savings product, it brought a bit of problems. But recently, when we took lending product, it brought problems to date, and we are still working on modalities of trying to find a balance, because we have mobile lending, which is doing so well, even though it is expensive. It's expensive because we have not found too many competitors in this space in order to lower the cost. But central bank keeps on saying we need to do something here. But recently, other products, especially the merchant use of mobile money by merchants or SMEs, has made them quite happy, but very hesitant also on how much money can actually be allowed to move in that space, especially business to business. And they keep on, we are actually, as I speak to you, there is a new policy that is coming to regulate mobile lending, which is one of the much older regulation which didn't work, but they are going to try, because there is nothing in place to regulate mobile lending. And they're doing it because when the mobile lenders began to lend using credit score, quite a number of defaults were there. And because those who defaulted go into the Credit Reference Bureau, I think the central bank decided to create a stricter regulation. Actually, they removed that any people who had borrowed through mobile platforms cannot be under the credit reference. Actually forgave them. The idea was that it was the people who would go through the credit reference would later be more careful with the way they used money, because some would work to raise money to pay for credit, but then central bank still stands in the way, trying to do things in a very conservative way that have not pushed this forward. Even though I want to show one slide here, even though a lot of changes are happening on the ground. If you look at this M-Pesa alone, its contribution to GDP is about 10%. And the velocity, the movement of the money in the economy, almost 70% of the money that is moving is 70% of it goes through the platform itself. With 28 million customers, the SME merchants are about 300,000 with a turnover of 1.5 billion per month. And then the large enterprise, $5 billion per month. So there is a huge benefit from this with respect to structural transformation of the economy when you make these SMEs much more efficient. I remember last year when COVID came in March, and virtually we were on lockdown. And what happened is that we do some research with women, especially vegetable vendors. They called and said, now we don't know what to do. We have all our fruits and vegetables we can't sell, we can't get to our customers. And we decided to reform WhatsApp. We asked them to take pictures of their supplies and send to their customers. And the customers responded and ordered what they wanted. But then they were asking, so how do we get this? We looked around for the motorbike riders and trained them on how to use the Google Maps, and they delivered. We actually created an instant e-commerce platform that they began to compete with the existing e-commerce platform, because now they could get to the customers can pay through the mobile, and they were doing this seamlessly, like nothing happens. It has disrupted such that these women, some of them, are not coming back to the marketplace because they found it easier. They could operate from their homes, and the motorbikes can pick from their homes and deliver to their customers, completely changing the way businesses are being done, simply because we had a payment platform. And this payment platform has created credit. You follow these women, most of them, they borrow very early in the morning, and much of it is paid by afternoon or within 2 days to minimize the cost of money. So there are some things, even when we argue that the cost of lending is so high, it is high for those who take for like a whole month before they're able to pay back. And it has helped to generate enterprises and even expanded. If you look at this next slide here, this is the banking landscape in Kenya. I hope you can see the first one here is Equity. Almost 95% of their lending now is over the mobile. KCB the same, and you can say almost 90% of the lending in Kenya now is on the mobile platform. And hence, the reason why central bank, instead of creating a legal sandbox to understand how to create a competitive environment so that the pricing can stabilize by itself, they want now to limit the lending rates, which failed actually when they did it a few years with the banks. We are looking forward to see how we shall overcome this challenge where central bank wants to control the lending rate of mobile platforms, something that failed with the banking sector. For 2 years, we had controlled interest rates, but it changed later on. And because the mobile lending platforms, the lending rates are quite high. They are quite high because they don't seek for collateral. So it has to be very high. But as more competitors come into the marketplace, you would begin to see pricing dropping down. And hopefully, central bank would have waited for such so that you have the market dynamics to bring down the interest by themselves. But we still have those challenges where they react without allowing innovation to take place. And we are going to see more and more come into play because we are seeing new products underway, especially those that will transform the SMEs, the micro enterprises, the large enterprises also that are using these platforms. I think I would stop here. Maybe I would respond to some questions later on.
Great, thanks, Dr. Demo. I'm going to ask you to stop sharing screen. Okay. And I'm going to invite all the panelists to join me. So Seth, Leora. We have a bunch of questions from the audience. Actually, really pleased. We have so many questions from the audience. And some of them are kind of quite general, and some of them are directed at particular people. So I'll try to manage that, but please feel free to jump in and add things. You know, I'd like this to be a conversation. So I think we're off to the races. Let me start with the first one. So I think the first one, I'm trying to figure out if I could, there's upvoting, so they might move around. So excuse my Zoom lack of skills, and so to speak. So there's a question for Leora. Would you have additional information on any recent strategies launched by mobile money providers to increase the uptake of digital payments for women? And are there any specific kind of gender barriers that you've seen?
Yeah, thanks. Yeah, no, there are a number of questions on the gender dimension, which is hugely important. I mean, actually, pulling some numbers, you know, from the Findex data, for example, according to the last data in 2017, we find a significant gender gap in Cote d'Ivoire, Kenya, Senegal, Uganda, in adults who have a bank account. However, we find no gender gap in the share owning a mobile money account only. So for example, in Kenya, men are 18 percentage points more likely than women to have a bank account, but women are 11 percentage points more likely than men to have a mobile money account. And what explains this? I mean, part of, you know, certainly one explanation is that simply all the benefits of having a formal account, some of which Seth discussed, you know, but including even bank accounts. We know that when women have their own account to save their money, it has an impact. The randomized control trials have shown an impact on household budget decisions, you know, related to household buying more nutritious food, for example. And secondly, I think an important point is the type of transactions that women typically make. Women we know are typically make more high frequency, low denomination payments. So she may be paid, you know, for a morning's work or informal work, or, you know, or work that she fits in between other household responsibilities. And I would say the most important payment that a woman and men make is a payment to themselves in the form of savings. And there too, we know that women are more likely to make high frequency, low denomination savings payments. You know, so for example, I interviewed women in Ghana who were paying susu collectors. So these guys who come around on a moped and take a small amount of money every day in savings and return the money at the end of the month, but charge a full days of savings. And, you know, for example, from the Findex data, over 30% of women who reported only using these susu collectors to save said they had a bank account, which makes no sense, right? And so we asked them, why would you pay money to save when you have a bank account? What they said was they couldn't keep $1 in their home overnight without the money being borrowed or stolen from another family member. And banks are designed for these high frequency, low denomination payments. When a woman isn't going to take a bus across town to wait online at the bank to pay deposit $1 every day. However, mobile money accounts, and especially the mobile money agent network, is especially designed for these sorts of payments and savings transactions. It's convenient for a woman to go to an agent potentially on her block, where also she might feel more comfortable than walking into a bank and know the agent to deposit that this type of payments. And so there are tremendous opportunities for women in mobile money. I'm happy.
Thanks, Leora. I'm going to ask panelists to keep answers a little shorter, just so we can get through a lot of them. We've got about 30 Q&A, so I'm not sure we're going to get to all of them. I'll ask the JPAL staff to keep the Q&A so we can get back to people. So there's a question for Seth from Sibel. I apologize if I mispronounce names. So they say much of the success of mobile money rests on reciprocity in friend and family groups. There's certainly a benefit to the recipient. What's the impact on sending households? And what's the impact of the loss of food production if people leave ag or leave the agricultural sector?
Yeah, no, these are good questions. I mean,
Seth, if you want to add to me, let me know.
Yeah, no. I think Professor Suri is well positioned to answer a lot of these. I'll just say quickly that I'll let you speak about your, actually, Tiffany, do you want to speak about your article on reciprocity? And why don't you go ahead first?
No, go for it, Seth.
No. You'll correct me if I'm wrong. But so I think a lot of these transactions, as we saw in this early article, Tiffany wrote with co-authors, is that mobile money increases the fraction of transactions that are reciprocal, right? And so, first of all, you have how we should be clear that it's often relatives that are sending money to other relatives. In some cases, it's migrant workers remitting payments or transfers back home. So you're essentially supporting your own family. But for those cases where it's not within family, but it's between families, you also see that, for example, the story is this: I face an emergency. I ask my friends to send me funds during an emergency so I can smooth my consumption. When my friends then face their own emergencies, which are unexpected, I will then reciprocate and send money to those folks. And so it's this kind of informal insurance mechanism. And it's increasing the efficiency of that insurance mechanism that really is the heart of the story here. But Tiffany, maybe you can answer that.
No, you did good, Seth. You said it perfectly. Awesome. Thank you for that, Seth. I think this one I will direct to Dr. Demo. Someone's asking, can you comment on the high charges for mobile money transfers, especially in countries like Uganda? They've also witnessed government shutdowns, disrupting use, especially during elections.
As I said earlier, what governments needs to do is just allow the market. The market would bring down the cost. That's how it has happened all through. But when they rush to put caps and other things, of course, Uganda was a different case where they closed down and almost messed up everybody. That happens in a couple of governments in Africa. But with respect to the credit, the rates that the mobile lenders charge, that would come down by allowing more players.
Great, thanks, Dr. Demo. Okay, I have a question from John for both Leora and Seth. So you guys figure out who takes this one first. How can, I guess, digital financial services or payment services be encouraged in a country like South Sudan, where illiteracy rates are the highest in Africa, there's no electricity, and there's less network coverage?
Dr. Clapper, I'll let you take that one.
Leora, is Sudan in the Global Findex?
It is, and no, absolutely. So, and then when we get more concerned, two things. One is we know, interestingly, in 2014 already, when we started asking questions about how people were sending remittances around the country, people reported mobile money before there's even a mobile money service. People were informally sending minutes around, cashing out. I referred to, the one guy in the mom's building to the phone as a local banker. And the mom was getting 50 cents on the dollar between everyone's cuts on how the money was being sent informally. So the formal mobile money service providers did play an important function in these countries. Certainly it raises a lot of challenges around lower income countries, for example, digitizing government transfer payments to mobile money accounts. And we're very concerned about, especially government transfer programs which target the poorer, potentially less literate, numerate adults, making sure they understand their accounts, how to prevent fraud, et cetera. But that's part of the challenge. I mean, there has been success using images on phones to support illiterate workers. Short answer is, absolutely, from the starting gate, there needs to be a strong consumer protection framework to ensure that vulnerable customers aren't, there isn't predatory outreach of additional financial services.
I just want to add really quickly that agents are an essential component even when everybody has mobile phones. And so we see that in India, Pakistan, some other geographies in South Asia, over what we call over-the-counter transactions, so directly going to agents and having agents facilitate the transaction, is a way of facilitating transactions when folks are not particularly literate, they don't have access to high-quality phones and things of that sort. So there are ways leveraging agent networks, but connectivity is a major constraint. That's absolutely true.
Yeah, Seth, I would just caution from Leora's work on that they've shown that even if there is over-the-counter, sometimes you get overcharged with over-the-counter because people are not literate. And Leora's worked a little, maybe Leora, you want to jump in quickly so I don't miscite your work about how you kind of reduce that sort of over-the-counter overcharging in some sense, because if people are not literate, they might not know all the charges.
So you add what I think is a really important avenue of unexplored research, which is the governance of agents, which we know, globally is a challenge in terms of overcharging and fees. In Bangladesh, we simply document that savvier financial workers, government workers who are paid directly in their wages into an account, become savvier financial customers. And so they're the agents in areas around factories that pay electronic wages are less likely to add on additional fees. But we don't have any suggestions on how to otherwise reduce those risks. But I agree with Seth that in best cases, agents are really important, offer additional important support to workers. I mean, the nature of the digital technology of mobile money accounts also offers other opportunities. For example, South Africa long ago is already starting to use, with banks, for example, sending text messages to people every time there's any activity in their account, any change to their credit report. And so once you're working with literate communities, certainly additional support, financial education could be provided in real time via text messages and other technological support systems.
Great, thanks, Leora. Lots more to learn. I think this is a general question, but maybe Dr. Demo, it's sort of somewhat directed at someone who's been in regulation. It's from Siddharth. He says, mobile money is in some sense a platform good. Do you think it's beneficial for a single player like Safaricom to control the market? And then maybe for the others to jump in, do we see differential effects of mobile money when the market is more fragmented, like in India or other places?
But there's still a lot of room for more people to come in and challenge what is happening. And the regulatory environment has pushed for interoperability. So everything from the regulator side has been done. I think you need a very strong competitor to come into the market and deal with.
Impacts from Leora, Seth? At least from the Africa studies, I don't think we see a difference, right? But I don't know about the India. I don't think there's been a full India one as far as I know.
No, I will say that this is kind of a robust area for additional research. I think, even in high income context, we have, we're constantly thinking about research, whether it's in the digital platforms, for example, the e-commerce platforms. This is all new. And so, when we think about this in mobile money as well, there are lots of reasons to think that increased competition, as Dr. Demo mentioned, will drive innovation in terms of products offered, in terms of folks who are more willing to enter maybe less profitable parts of the country, and things of that sort. And so I think where we have concerns is that, kind of monopolistic or duopolistic types of settings where there's just one or two dominant players, there might be a strong incentive to just kind of take advantage of the more lucrative sectors and not go kind of downstream into the less lucrative products and also areas. And so interoperability is something that we believe can facilitate that competition to the benefit of the consumers, but it's an open area of research. It's something where we've been supporting some additional research, and I think it's a very important question, particularly as we see increase in the types of products offered, credit, insurance, et cetera. So we'll keep our eyes open and try and support more work on this, and hopefully JPAL can help us.
Absolutely, Seth. I think one other thing that's worth saying is just sometimes when you invest in the infrastructure, and certainly the agent network, I think of as infrastructure, you can think of this as a natural monopoly, right? You're going to have one set of infrastructure, but then, you know, it requires a regulator to step in, because whenever we have a natural monopoly, we're worried about this sort of behavior. So I you know, maybe this is a question for Dr. Demo a little, which is, you know, if you think of it as a natural monopoly, do you think there's a role to regulate kind of the prices or the costs, I guess, is the price here?
Actually, the smaller startups are doing much better than some of the current competitors. If you look at we have almost 1,800 mobile lenders in this country, but the key ones are like 9 or 10. But it is the branding that has given M-Pesa a much longer period than the new ones could get into the space. But I know for sure that they are making headway, and that's not something that I can talk from, because I still sit in the board.
Yeah, fair enough. Okay, I'm going to take a question from Kurfi, who's asking, for a country with low health insurance penetration, what role do you see mobile money playing in addressing this? Whoever wants to jump in, please feel free. Seth looks like he's ready to go. Go for it, Seth.
I was going to suggest Lior and Dr. Demo who are closer, but I'll just say that what we do see across different segments, whether it's insurance, whether it's microfinance, which I know a lot of folks might be interested in, is that just facilitating the ability to pay, for example, premiums or to disperse is super valuable. There are also all kinds of innovations to validate that people have had the negative experience that they're claiming for insurance, for example. And so to the extent that you could just continue to reduce the transaction costs and also improve some of the quality of the kind of monitoring of these I think those are all opportunities. And also, frankly, just the fact that you have an incredible user base, like Dr. Demo demonstrated in Kenya, you just have an incredible, make these products more accessible to folks, to a large consumer base that otherwise might not have access to the marketing and things of these products that normally are focused in the urban centers.
And just to add, exactly, that having this large user base, for example, offers opportunities to move from various insurance products to government, for example, instead of alternative to free clinics, offering health subsidies. And so giving governments the ability to consider subsidy payments versus services.
Yeah, and I'll just do another plug for Digify, Seth, because this is one of the pieces we're thinking about with ID systems coming in. Is it going to enable people to both get health insurance and pay for it digitally? So it is part of, hopefully, a research portfolio happening and ongoing in our under the Digify umbrella. Dr. Demo, anything on health insurance?
There are several products that I know that are coming. We launched, I'm saying we, Safaricom, launched something on health wallet and micro insurance, I think is on the way. So that there's a lot that is going to happen in that space, not just from Safaricom, but there are several other products that are coming.
Great, so more products and more research opportunities. I think, Dr. Demo, to understand how these affect not just take up of health insurance, but maybe hopefully health outcomes. Okay, let me take a couple more questions because we have time and there's lots of them. So I have a question saying mobile money is from George saying mobile money is a key enabler of pay-as-you-go models. To what extent have the interaction effects of digital inclusion or digital financial inclusion and energy access been studied?
There's quite a number of. Oh, go ahead.
No, please, Doctor.
Go for it,
There's
Dr.
quite-
Dembo.
No, I'm saying there's quite a number of papers in that space, especially the green energy and the mobile payments. We have a couple of companies in that space. I'm sure you know that have met, and there have been papers out of it. I don't know whether they need specific papers or how far.
Yeah, so Leora, did you want to jump in?
I was going to add, there's been a number of excellent surveys of the users and providers of pay-as-you-go models in Africa, as I mentioned, including by my colleagues at CGAP, which have showed that yes, it has managed to increase electricity access, and yeah, as I mentioned, also often bundled with loan payments to purchase solar panels, for example. But I also mentioned, yeah, I think it's really interesting some of the unintended consequences of these pay-to-go models. For example, one study by CGAP that found that the household's payments typically came out of the woman's disposable income, and it had an impact on women's spending and other household payment for other household expenses. And so a more rigorous evaluation of both access to the utility, the impact of having access to utility on the household's income, and most importantly, the redistribution of income spending.
Great, thanks for that, Leora. Yeah, I think there's a couple of new papers just coming out looking at pay-as-you-go models. One of the most popular ones, at least in East Africa, is something called MCOPA, which is the energy one.
That's what I mean.
Yeah, and so I think there's a group at Berkeley working on some of this too. Seth, did you want to jump in?
No, I think there's a researcher from resource economics at Berkeley from CEGA that's published some work on that. I think also we should differentiate between like mobile money and digital-based financing for more consumption-oriented services. So households that are kind of going to spend on additional solar lighting for their homes, versus inputs into productive processes. And I think something where we could use a lot more research, and I think is particularly excited from a development perspective, is the extent to which digital finance can lead to improved financing for productive inputs. So for example, on farms, leveraging digital finance for asset-based financing for inputs. There's some positive research on asset-based financing for water cisterns, for example, which actually was not digital, but you can imagine all kinds of reasons why digitization could encourage that kind of asset-based financing. And then recently in Pakistan, moving towards larger loans, asset-based loans, kind of much larger than traditional microfinance loans. I think there's a lot of opportunity more on the product that I'm most excited about on the productivity enhancing side. Although certainly there's a big market for the consumption side as well.
Thanks, Seth. Yeah, I think clearly lots of things to study around this, Leora. Where's the money coming from? How does it affect women's outcomes, not just coming from their pocket? So for those, researchers out there, lots of things to study. Okay, let me take a question from Melanie, and she's asking about whether there's studies focusing on youth and mobile money, in particular looking at youth self-employment and youth micro small enterprises.
I'm not familiar with any results, but I know, for example, in the MENA region, in the Middle East and North Africa, which has huge bubbles, as well as many countries in Africa, there is some work ongoing on using, leveraging phones to provide business training, and also coupled with additional loan repayments, etc. But I don't know of any results yet. Seth, do you?
Yeah, Seth, do you?
I don't know of specific results, but I will say that, and Lyra, correct me if I'm wrong, but I think we see a high level of kind of familiarity and kind of literacy around use of technology among younger populations, which is kind of natural. And I think that is really positive in the sense that some of the major constraints in terms of trust, literacy, access to technology to facilitate these types of digital transactions and digital use cases is in principle going to get easier, both as the connectivity increases, but also as the demographics kind of, the younger demographics are just more familiar. So I think it's very promising. It'd be nice to develop some of that evidence that I think we are lacking on the youth population.
Yeah, great, Seth. I would say the same. I'm not sure I know any studies targeted just at youth. There is stuff on small enterprises. So Emma Riley's recent work is on micro enterprises owned by women. I'm not sure it's youth necessarily, but there's a piece around enterprises, but I'm not sure focused on youth. Sorry, Lyra, I jumped in.
There's actually a couple of master's theses from our university, which started mobile lending for specific contracts from government that are directed to youth and where they borrow from to fund their activity.
Cool. Lyra, did you want to add anything?
Just from the data side, it's sort of an intriguing physics finding is that we find, especially throughout Asia, very small to no gender gaps among younger women, between younger men and women. But that gap, the reason there's a large gap overall is because as the cohorts age, for example, by late 20s, men are much more likely than women to have an account, a bank account. That's because men start getting accounts for their businesses, to receive transactions, to manage the household, et cetera. But what is interesting in sub-Saharan Africa, we don't see that. We don't see the gender gap increasing with age, which is suggestive that women use a mobile money account, even if they're not the head of household, or running a business, because it's less expensive and more accessible. And so, there are tremendous opportunities, especially among self-employed women, to expand their access to financial services.
Great, thanks for that. I'm gonna try and grab a few more questions before we run out of time. So there's a question from Kilugala. I hope I'm saying your name right. I think it's for Lyra. She's asking, they are asking if mobile money would have effects crowding out or in on other suppliers of financial services. She's from Tanzania working, and the telco's providing these micro loans, which has already been happening in Kenya too, as you know, Lyra. And their thinking is they're crowding out of microfinance and retail banking. And do we have any evidence on that? Squarely in your lap, Lyra.
So excuse me, I don't know of any evidence. However, we talk about like best practice being the interoperability of mobile phone companies among providers, so you can send money from one provider to another. I think it's also really critically important to have interoperability between financial service providers. So for example, in West Africa, we're seeing a growing trend of mobile money companies, which typically aren't allowed to pay interest or earn interest on their deposits, partnering with banks. And so, and in some cases, splitting the interest proceeds from saving balances. And so mobile money agents are almost effectively working as bank agents, right? So they have the rural reach, the contacts with poorer communities, with women, the comfort level to collect those mobilize that savings. And then, apps like the one we're working with in Ghana that can costlessly sweep money from a mobile money account into a bank account where the money could then potentially earn interest, as well build a relationship with the banks. And so this is a form of competition with the fintechs and also allows MFIs and other lenders that service the bottom of the pyramid to provide funding via the mobile money apps.
Yeah, so it feels like more of a crowding in than out yet at the moment, maybe, but more to learn, I think, Lyra. A question for Dr. Demo from Anit. Does the central bank make a distinction, or should it, I think also is a good question, between default on consumption loans, like for sports betting, versus default by small enterprises? How do you think about sort of those two different types of default, and should they treat them differently?
Actually, lending is lending, but I posted the new law that central bank is proposing. And if you look at the people who are defaulting, they were men who are gambling. And when they do a general law, it affects women who are never using their resources in gambling and hence getting into problems with credit. So that's why I normally argue that if they left it and locked them out, the fear is that, well, they would go and ask their wives to borrow for them to go gambling. But it's not good to have a general law when you know there is a category of people who borrow and repay. And then they cover them with that, with just a general law. I think there ought to have been some level of consideration that this is where the problem is and deal with it, either with counseling or whatnot or anything, and passing a law which impacts on everything.
Great. Thank you for that. Let me take a question from going down the list. So Stephanie asking about metrics of the impact of increased connectivity, and are there barriers to connectivity? So is there a way to kind of think through not just the mobile money piece, but the connectivity piece, which gets you to a phone, which gets you to mobile money? And is there work there? Seth, do you want me to take this one, Lyra?
Go for it.
Okay, so there is a bit of work. I'm going to post a VoxDev link in the chat just because I get to plug VoxDev now. There's a bunch of work around the impact of the internet, and we've done a bunch of VoxDev articles, so I think I'll direct people there. I think some of also the mobile money work, including Lyra's new stuff, I think is now up there, right? Yes, I remember tweeting it, Lyra. So I will direct you on connectivity. I think one question for Dr. Demo is how he thinks about regulating the connectivity piece, right? Entry into the sort of more hard to reach parts of countries is really hard. And is there a role for a policymaker to encourage it or a regulator? Just because you've worked on this piece so much, I thought it'd be nice to hear from you.
Yes, what we did, we forced the telcos to share infrastructure, minimize cost in some of the areas that were not economically viable to have where there is a sparse population. But I know like Safaricom has covered almost 95% of the population with 4G. There are still pockets in some places where the government either to subsidize satellites or to be able to use the resources from the regulator to build the base stations and allow them to be shared by telcos. That's a very small percentage of the population, and that's where the government can invest in where there are no returns.
Great. Seth, did you want to add?
I think that's great. I also just wanted to add, I think thinking about infrastructure broadly is really important from a policy perspective. So connectivity and being able to share common infrastructure is straightforward when we think about base stations. I think we should also expand our thinking about, what you called infrastructure earlier, Tavneet, which was the agent networks. And particularly, if we think of the last, 20%, 25% of those that are not included, I guess in Kenya, it's more like 15%. Largely the kind of rural countryside, how do we get the infrastructure of the agents and the base stations to those folks? And I think we do need some innovative policy decisions. We should start to experiment with subsidies and pilot different commission structures. And so I think that's relevant both from the connectivity in terms of the base stations and the telcos, but also in terms of the agent infrastructure as well, which is a major component. In the last second, I just wanted to follow up on Dr. Demo's discussion about regulation and of the lending and things of that sort, the digital credit. To plug the JPA's sister organization, Innovations for Poverty Action, IPA, has a major consumer protection research initiative as well, which is exploring a lot of these topics on market monitoring and misconduct. So for those that are not familiar, you should check that out as well.
Great, thanks, Seth. I think we are out of time. I'm going to ask Jenny Aker, who is the new Digify co-chair. She's just joined the team, and we're really excited to have her. She's a professor of development economics at the Fletcher School and with the Department of Economics at Tufts. And she also directs the Fletcher Leadership Program in Financial Inclusion. She works mostly on mobile money, not mostly, she does work, some work on, sorry, Jenny, I didn't mean to narrow it, on mobile money and digital finance in West Africa. We're really pleased to have her here. We just had her join as co-chair of Digify, I think a week ago, Jenny. So she can close out the session for us. I will just say, you know, if you guys have questions, I know we didn't get to all of them, please reach out to us. It's digifyafrica@povertyactionlab.org. Happy to take questions about both Digify or other initiatives that study all the various aspects. Jenny, the floor is yours.
Yeah, so a big thank you to Tavneet, and thank you for all of our panelists. I thought that this was really interesting and kind of was addressing many of the issues that I think we've all been grappling with. I mean, Seth, it was great to hear about kind of thinking about first generation digital financial services and how that reduces transaction costs, you know, increases access to remittances, allows households to smooth consumption, and then kind of reduce poverty. And then from Leora, we heard from you about different use cases in terms of agricultural direct deposits and merchant payments. I hadn't known about a lot of those, so I thought that was really interesting and innovative. And thank you for thinking about some of these big unanswered questions. And then Dr. Ndemo, I think you really hit it home about kind of the importance of policymakers and regulators in this space, both to facilitate kind of the growth of mobile money and second generation digital financial services, and also some of the challenges we're facing as well. What I heard in the chat, I think there were kind of 3 or 4 main things that came up, and I'd just like to synthesize them. The first thing was this broad kind of question about how do we really address constraints in take-up? You know, that we've seen this amazing growth in certain areas of the world, kind of Kenya and Tanzania were put forth as 2 really important case studies, but there are certain countries that still really struggle with kind of uptake and usage in basic mobile money services. And, you know, how do we address these constraints for specific populations, whether that's for women or those who cannot read or write, as we saw in South Sudan, or those who don't necessarily have access to kind of complementary services like electricity. The second big question that really came up is, you know, what is the role of regulation here or policy in terms of kind of taxes, interoperability, costs? We talked a lot about agents and kind of complementary infrastructure. And then the third big thing is that, you know, as we've seen the growth of these second generation digital financial services, whether that's kind of, you know, M-Shwaris or digital credit, insurance and savings, kind of what is the impact, and does that bring kind of new challenges that we all need to be grappling with? Some of the other things that I saw in the chat that I think we're going to be learning more about over the course of the next year is the role of mobile money right now in social protection payments, specifically in kind of the era of COVID-19. So I look forward to kind of talking with you all more about this and kind of looking at some research proposals potentially in Digify as well, because I think these are really important things that we need to learn about and learn from each other with. So finally, in terms of a thank you, I just want to thank everyone who contributed to the organization of this, JPAL Africa, in particular, a shout out to Thokozile Malaza, MIT's IT department, and then the JPAL Global Comms. And thank you all for your participation and questions. And as we said, we're available to engage with you further on this.